Ever wondered which ETF is better between VGT and QQQ? Well, you're not alone. Today we're peeling back the layers of the investment world to explore the nuances of these two popular exchange-traded funds. ETFs, as they're commonly known, are pivotal financial instruments that offer a plethora of investment opportunities. They're like a buffet of stocks, giving you a taste of various companies without the need to buy individual shares. Now let's talk about our stars of the day, VGT and QQQ. VGT, or the Vanguard Information Technology ETF, focuses on stocks within the technology sector, while QQQ, the Invesco QQQ ETF, is geared towards the NASDAQ 100 index, embracing a wider range of sectors. Both have their unique strengths and attract different types of investors. So the burning question remains, where should you park your $10,000, VGT or QQQ? Stick around to find out which one of these ETFs could potentially give you the best return on your $10,000 investment. Let's begin by understanding what VGT and QQQ really are. Vanguard Information Technology ETF, or VGT, and Invesco QQQ Trust QQQ are two of the most popular exchange-traded funds, or ETFs, on the market today. Both of these ETFs offer investors exposure to a broad range of technology and tech-related stocks, but they do so in slightly different ways. VGT is an ETF that focuses primarily on the technology sector. It's managed by Vanguard, a company well known for its low-cost passive investment products. This ETF tracks the performance of the MSCI U.S. Investable Market Information Technology Index, an index made up of stocks from all sizes of U.S. companies within the information technology sector. On the other hand, QQQ is an ETF that tracks the NASDAQ 100 index. This index includes the 100 largest non-financial companies listed on the NASDAQ stock exchange. While technology companies make up a large portion of this index, it also includes companies from other sectors such as consumer discretionary and healthcare. So, in essence, VGT offers a pure play on the technology sector, while QQQ provides a broader exposure to the largest and most influential companies on the NASDAQ. This means that the performance of these two ETFs can be influenced by different factors. For instance, VGT's performance is heavily tied to the overall health of the tech sector, while QQQ's performance can be affected by a wider range of industries. It's also worth noting that both of these ETFs have a strong focus on large-cap stocks. These are companies with a market capitalization of $10 billion or more. They are typically more stable and less risky than smaller companies, but they may also offer slower growth. Finally, let's touch on the geographic representation. VGT is concentrated on U.S. stocks, while QQQ, although heavily U.S.-focused, does hold some international stocks. This gives QQQ a slightly more diverse geographic exposure compared to VGT. Now that we know what these ETFs are, let's dive into their past performance. Past performance isn't indicative of future results, but it does give us a hint of what to expect. Let's dive into the history books and see how these two ETFs, VGT and QQQ, have played out over the past years. Vanguard's Information Technology ETF, VGT, has seen a significant surge in its performance during the previous decade. From a modest beginning, it has grown into a powerhouse in the tech sector. The fund has consistently outperformed the broader market and has been a go-to choice for investors seeking exposure to technology stocks. On the other hand, we have the Invesco QQQ ETF, which tracks the NASDAQ 100 index. This fund has also shown impressive growth, notably in the last half-decade. It boasts a diverse portfolio that includes not only tech giants, but also companies from various other sectors. This diversity has allowed QQQ to deliver solid returns, even in volatile market conditions. Now let's compare them head-to-head. Over the past 5 years, VGT has gained about 80%, while QQQ has climbed up by approximately 70%. If we extend the timeline to the last decade, VGT's growth is a staggering 250%, with QQQ trailing behind at around 200%. However, these numbers don't tell the whole story. While VGT has had higher returns, it also had a higher standard deviation, meaning it experienced larger swings in price. QQQ, on the other hand, has shown relative stability compared to VGT, which might be appealing to investors who prefer less volatility. So, which one is better? It all depends on your risk tolerance and investment goals. If you're a risk taker aiming for higher returns, VGT might be the right choice. Alternatively, if you prefer a more diversified portfolio with steady growth, QQQ could be your go-to ETF. Remember to drop a comment below about your own experiences with these ETFs, and don't forget to subscribe. In the next scene, we'll explore the risk levels of both VGT and QQQ, so stay tuned. No investment is without risk. Let's see how VGT and QQQ stack up in terms of risk levels. As we dive into the universe of ETF investments, it's essential to remember that every investment comes along with its unique set of risks. Sure, the potential for profit is exciting, but it's equally important to understand the risks associated with your chosen investment. So, let's take a look at VGT and QQQ. Both of these ETFs are part of the technology sector, which is inherently volatile. This volatility implies that the value of these ETFs can swing significantly in a short time. If you're an investor who can stomach these ups and downs, this might not be a problem. But if the thought of significant fluctuations keeps you up at night, you might want to consider a more stable investment. VGT focuses on the information technology sector, which includes companies like Apple, Microsoft, and Visa. This concentration means that the performance of these companies can heavily influence VGT's overall performance. It's like putting all your eggs in one basket. If the tech sector takes a hit, VGT could suffer more than an ETF with a more diversified portfolio. On the other hand, QQQ tracks the NASDAQ 100 index, which includes the largest non-financial companies listed on the NASDAQ. It's not just tech-focused. It covers sectors like consumer services, healthcare, and industrials. This diversity can provide a cushion against volatility in any one sector. However, it also means that QQQ is exposed to the broader market's fluctuations. If the overall market takes a dive, QQQ could follow suit. Risk is a tricky beast. It's unpredictable, and it's impossible to eliminate completely. But understanding the risk levels of your investments can help you make informed decisions and potentially avoid catastrophic losses. Remember, risk and reward are two sides of the same coin. To earn potential rewards, you must be willing to assume some level of risk. Understanding the risk is crucial, but so is knowing the costs associated with these ETFs. Stick around for that. Expense ratios might seem small, but they can eat into your returns over time. Let's dive into the world of expense ratios, those pesky percentages that can nibble at your investment returns year after year. To put it simply, an expense ratio is the annual fee that all funds or ETFs charge their shareholders. It's how the fund company makes its money. This fee is taken out of your investment returns, so the lower the expense ratio, the better it is for you as an investor. Now let's bring VGT and QQQ back into the picture. The Vanguard Information Technology Index Fund, or VGT, has an expense ratio of 0.1%. That's right, just 0.1%. On the other hand, the Invesco QQQ Trust, or QQQ, has an expense ratio of 0.2%, double that of VGT, but still quite low compared to many other ETFs out there. What does this mean in the grand scheme of things? Well, if you had $10,000 invested in each fund, you'd pay $10 a year in expenses for VGT and $20 a year for QQQ. That might not seem like a lot, but remember, these costs compound over time. And over a period of 20 or 30 years, that could mean a significant difference in your overall returns. Furthermore, it's not just about the expense ratio, it's about what you're getting for that expense. VGT is focused solely on the technology sector, while QQQ provides a broader exposure to the NASDAQ 100 index, which includes companies from various sectors. So, you're not just paying for the fund's expenses, but also for the kind of exposure and diversification it offers. In conclusion, while VGT has a lower expense ratio, QQQ might offer more diversification. It's a fine balance between cost and coverage, and it's up to you to decide what suits your investment strategy and risk tolerance best. Now that we've covered the expense ratios, let's wrap this up. We've looked at past performance, risk levels, and expense ratios. Now, where should you invest your $10,000? Let's recap what we've uncovered about these two exchange-traded funds, VGT and QQQ. VGT, the Vanguard Information Technology ETF, focuses on tech stocks in the U.S. It's a sector fund, focusing heavily on a single sector of the market. This focus has its pros and cons. On one hand, it's allowed VGT to ride the wave of technology's explosive growth. On the other hand, it also makes VGT more vulnerable to tech industry downturns. QQQ, the Invesco QQQ ETF, takes a broader approach. It tracks the NASDAQ 100 index, which includes the 100 largest non-financial companies listed on the NASDAQ stock exchange. While it's still tech-heavy, QQQ is more diversified across sectors. This can potentially offer a buffer against volatility in any single sector. When we compared past performance, we found that both VGT and QQQ have shown impressive returns over the past decade. However, VGT has had a slight edge, largely due to the tech sector's strong performance. But remember, past performance is no guarantee of future returns. In terms of risk, both ETFs are considered relatively high risk due to their focus on growth-oriented tech stocks. But QQQ's broader sector diversification could provide a bit more stability in volatile market conditions. As for expense ratios, VGT has a slight advantage with an expense ratio of 0.1% compared to QQQ's 0.2%. While this difference might seem minor, it can add up over time, especially for larger investments. So, considering all these factors, where would be the best place to invest your $10,000? It's a tough call, but if you're looking for sector-specific exposure and are willing to accept the associated risks, VGT could be the way to go. Its strong past performance and lower expense ratio give it the edge. However, if you want a more diversified exposure to large-cap growth stocks, and you're willing to pay a slightly higher expense ratio, QQQ could be a better fit for your portfolio. Before making any investment decision, remember to consider your own financial situation, risk tolerance, and investment goals. And don't forget the golden rule of investing. Diversification is key. It's always a good idea to spread your investments across a variety of sectors and asset classes to help manage risk. Remember, investing is a personal decision, and what works for one might not work for another. So do your own research and make the decision that suits your financial goals best. Thanks for watching, and don't forget to like, share, and subscribe.